Hey, folks, figure I'd jump on live on a Saturday night here. What is it? What is today? May 20. What the hell is today? I can't tell. May 17th, something like that. May 17th, 2019, May 18th. I just figure on a Saturday evening. No hockey game tonight. The Bruins are already in the Stanley Cup. Well, what's going on, Corey? What's the word? Big man, I figure I'd jump online here today, see who can show up on a Saturday evening. Typically, I do this on Mondays. That's my new goal, is to do it every Monday. Live sessions, Q&As. By all means, if you want to ask your questions in advance, it'd be helpful, frankly, so I could see those. You can ask here too, but I can see your questions for sure. Maybe if I need to dive into it a little bit, I can, and then I can keep like a little chart of the questions that I get. And on top of that, I can tell people like what the question is going to be about, kind of like in the title. You can only do that a little bit, but given there's no hockey, I don't much care for. I don't know if there's a basketball game on tonight. I don't know. Be a good night. All right, so let's start. Huge victory for freedom. Huge victory for freedom in Australia. The Australian Conservative Party beat back the Labor, who is running solely on a climate change agenda. I'm sorry if that offends you, folks. I am 100% for freedom, and the whole thing with this Green New Deal climate change is anti-freedom. There's no other way around that. It's a way to mandate how you live your life, and I don't want mandates on how I live my life. So if we can push back whenever we can, the green climate change New Dealers, that's a wonderful thing. So it's a huge victory, and the irony of it all, just like how Trump got elected, is it was the blue-collar workers in the coal mining towns that typically vote Labor. In this case, in America, be Democrats. It's amazing to me. And that's exactly what happened in Australia. All the election polls, all the polls, the exit polls is almost part and parcel of what happened here. Said that the Labor was going to win. In fact, there's articles that said it was an unlosable election for Labor. And they were running full stream, full throttle on about the green climate deal, going back to carbon, just all the stuff that we hear here, banning coal plants, and they lost unexpectedly. And I could not be happier. I love it. I love the fact that reality is kicking in, and the irony of it all. On top of the fact is the Labor Party's old school voters, like in America, the old school Democrats who used to vote, and it's crazy to me that the blue collar, hardworking people are now, who are generally keen on unions, are just being left aside. It's crazy. It's happening. We're gonna have a European election for European Parliament in the UK next week? Australia, US. It's just I don't understand this. It's crazy, but I don't care. It's for freedom. It's great. I love it. I love the fact that the people are telling you how to live your lives are getting their comeuppance. It could not be happier. And I am, for one, stunned. And I'm sorry if that's political. It is. I love freedom. And I don't care if it's freedom for being Democrat, freedom for being Republican. The facts are the Green New Deal is not for freedom. It's not. It's for command control. And when you cede power to the authority, you'll never get it back. And we know what happens there because it'll never be enough. This Thursday, says my man Rodney, will be the EU election in the UK. That's fantastic. I can't wait. I would not be shocked if we had surprises there too. On top of that, I think it's good as well for freedom because what's happening is bad. I mean, YouTube is the best of all of them. But I mean, on Facebook, you might not like the right, alt-right, whatever, but Candace Owen being banned for saying that abortion, more blacks are aborted than whites, and Facebook banned her. And that's just nuts, man. I mean, this stuff is crazy. I don't want to hear this private platform stuff. It's nuts. And so anyway, we can stick it to these people, the powers that be, the mainstream dominant culture. I love it. I love it. And so I'm stoked. So that was huge. Watching a video on Warren Buffett. He was interviewed by, hey, what's going on, Rob? My man, Rob, our Bruins fan, large and in charge. Normally, actually, there is no hockey game today, Rob, so that's why I'm on live, and I'm looking forward to Stanley Cup. I watched Warren Buffett, Charlie Munger, and Bill Gates be interviewed by whatever that lady, Becky from CNBC. I could care less about CNBC. Fox News business. I don't watch any. I don't watch Fox News. Just FYI for those of you, you're too right wing. I literally could care less. I don't care. What the Stanley Cup starts Memorial Day? We've got that net nailed down. Oh man, that's freaking fantastic. Anyway, I could not. I just don't care. It bores me. Anyway. But I did see, I was driving to Burger King today because I was getting a vanilla milkshake, and I saw on my my feed on my YouTube feed, oh, sweet, Memorial Day, okay, that Becky was interviewing Warren Buffett and with those other three guys, and Buffett said stocks are ridiculously cheap with the treasuries at 3%. That's 10-year. That's a 30-year treasury at 3%. Stocks are ridiculously cheap, And yet the irony was that Bill Gates had just said right before that stocks are high values, too high value, not too. I'm putting words in my mouth. He said stocks are very high valued right before that. So I found that to be interesting. That Gates Gates is not a money manager. Gates is a rich guy from Microsoft, and so my man Rodney says, wow, all the PE ratios are sure high. They're not high relative to the yields on bonds. And that's what happens all the time. So I'm going to bring up my little chart here. Tracy in Alabama, love this channel. Well, thank you, Tracy. So historically, because it looks like we have a PE ratio, you're not going to be able to read that, 15.5. PE ratio historically, I keep writing 8, and I mean to write 5. PE ratios historically are 15.5. That's historical. Yields on we'll just use 10-year bonds. That's always my proxy for your risk-free. A lot of people say risk-free would be 10-year treasury bills, and I get that, but I always use a 10-year treasury as a proxy because that's a good proxy for bonds, the bond market. Because you're not really competing. Stocks aren't competing with cash. The treasury bills are really competing with bonds. That's what's going on. Or you can say real estate. But interest rates higher makes real estate more expensive. So at the end of the day, the stocks are competing as an asset class with bonds, not with treasury bills, but with 10-year treasury bonds. And historically, the 10-year is about, we'll just say 5.5. So historically, that's what we're looking at. You can even say 5. It doesn't matter. But historically, the 10-year treasury bonds yielding 5.5, which means if I invest $100,000 in a 10-year treasury, I will get $5,500 in interest for that year. All right. I'll get $5,500 for interest for that year, the next year. So let me draw this out. I invest $100,000. It matures for $100,000. And I know this is chicken scratch, but I invest $100,000. It matures for $100,000 in 10 years, and I get 5.5% yield, which is $5,500 a year. So historically, this is what I get: $100,000 invested today. I get 5.5% is my coupon. I get $5,500 each and every year as interest, and it matures for $100,000. I mean, literally, it's as simple as that. So I take my $5,500, I times that by 10 because it's 10 years. I get $55,000, $55,000 in income. That's how it works. Nothing fancy there. All right, but now what's happening? My $100,000. All right, so today I buy a 10-year treasury at $100,000. What am I getting today? Remember, historically, I'm getting $5,500. And so today I'm getting, take a look at my trusty calculator here. We are getting if you see that small one right there, TNX, where's the TNX? Right there. What does that say? 2.39. 2.39. I don't know if y'all can see that. 2.39. That's the 10-year treasury. So the 10-year treasury is 2.39% right now, which means I'm only getting $2,300.93, which is less than half of what I was getting before. So if you look at the competing assets, you're saying, okay, stocks historically are 15.5. I'm typically trading 15. I'm typically paying $15 for $1 of earnings. Or I could take that money and actually go invest in a 10-year treasury and get $5,500 guaranteed without really any risk. Now I'm saying, okay, I can take instead of getting the $5,500, I'm only getting $2,300 for that same tying up my money for 10 years. Or the PE ratio, I think I read that for 12 months PE is about 19.5 today. So that's the PE ratio is 19.5. So the PE ratio, and that's the forward earnings projections on the S&P 500, 19.5. And we'll even just say 20 for the time being. So what we do is we say, okay, if the PE, we'll just say 20 for simplicity. If the PE ratio, the forward projections are 20, and historically it's 15.5, that means it's 4.5% higher than historical. So we take that 4.5%. 4.5. We divide into what it historically is, 15.5. And that's a 29% higher than normal PE ratio. 29% higher than normal. But then you have to look at how much lower is the 10-year treasury. If it's historically at 5.5 and now it's at 2.3, that's I don't even know what that is. That's I guess we do 5.5 minus 2.393 divided by 5.5. That's 57% lower. So the PE ratio on the S&P 500, the forward earnings, there's no guarantee on that, I grant you, is what I say, 29% higher, and yet the 10-year treasury is 56% lower as in terms of the actual coupon you're getting. And so when you look at what's called I don't want to say inverted yield curve, but we look at that as a inverted earnings yield on the 10-year treasury, it's not the PE ratios don't look nearly as high as they would historically, just because the competitive asset class, which is bonds, are incredibly valuable, that's why you have a lower interest rate. And so I 100% agree with that. I mean, that again, PE ratio forward looking in of itself is not, we don't know. I mean, historically they're pretty close on their analysis, but things called, I'm just drinking Walmart brand peppermint tea, by the way. But if that were to come to fruition, and it probably, it might be 21, might be 8, we don't know. But at the end of the day, they are higher than historical. But the yields on bonds are much lower relative to stocks, historically speaking. And I just find that to be pretty interesting. And then you factor in all the cash that these companies got on the side. So their dividend payout ratio, I did a video on this the other day. The dividend payout ratio is only, I think it's like 32%. And what that means, my friends, is that if a company makes $100 in profits of earnings, $100, and they pay out a certain amount of dividends, in this case, they pay out $28 in dividends, their payout ratio is 28%. So they're paying out how much of their earnings, not their revenue, but their actual earnings, are they paying out as a form of dividends. If they're only paying out 28%, that means there's a lot of wiggle room for them to increase their payout ratio, i.e. by increasing their dividends, if that makes sense. So not only are companies actually trading historically low PEs relative to the 10-year treasury, but their dividend payout ratios are also historically low as well, and they just have tons of cash on the side too. I think it's all positive. Now, with that said, they are using one of the reasons why the dividend payout ratios are so low is because they're using a lot of that cash proceeds to buy share repurchases. And well, that's a good thing. I don't know why everyone's all upset. Why the share repurchase is such a bad thing. Doesn't bother me in the least. All that does is reduce the amount of shares out there, which means inherently you're boosting the stock price. So, they can they can purchase back shares, they can increase dividends. I'd much rather have them do that than investing in some insane advertisements or just investing in some crazy business and pets.com or something like that. So I'm pretty optimistic. I am. I try not to let my politics get in my way. I get that, but I can't lie to you. The facts are the PE ratios are not extraordinarily high. The yields on bonds are incredibly low. There is a growth mentality now from the regulatory environment in the U.S. And I think it's great. And then you got cash on the side, tons of cash on the side. I think it's great. And then if Warren Buffett says if rates stay at 3%, and this is the 30-year now, which it is, stocks are incredibly cheap. And that's not me. That's the big guy there from Omaha. And look, Warren Buffett doesn't have my politics. I'll tell you that right now. But if Warren Buffett were to say that, I don't know what you could argue against. Now, one of the things that I still think at the end of the day, at some point, the spending is going to have to get under control. This is Republican and Democrat. And at some point, they're going to have to get this under control. But, okay, what are you going to do? The issue is you can't. The way they're going to get spending under control, we know it's going to happen. They're going to inflate the currency for sure. There's no other way around that with another quantitative easing. Hell, Trump wants to do that, and I don't agree with that at all. They're not going to do that, but the Fed won't. But that's one of the things he's talked about is doing another QE, quantitative easing, because he thinks the Fed raised their interest rates too quickly last year, which put a damper on growth. And I don't think we should be doing that. I think we've done enough under Obama. We don't need to do it anymore. At some point, though, the way they're going to pay down some of the debts, inflate without, everybody knows that. And so if they inflate the currency, what does that do to bonds? Well, it kills you. I mean, that's the issue. Inflation kills fixed assets. Deflation is a boon for fixed assets. So if you have bonds in the Great Depression, you are in hog heaven, man. And that's one of the things I find, Rob, interest rates historically low. I mean, it's not, and they're not going up. I mean, they haven't. Could they? Sure. Will they? I mean, I did a video of this on the other day about China selling their treasuries, and it was just clickbait. Not from, well, I guess you could say it's from me, just reading an article about China selling the treasuries, and yet the interest rates went down. I mean, when you think about it, when you're flooding the market, theoretically flooding the market with supply, and the demand hasn't changed. So right now we got an equilibrium and we're flooding the market with supply. Demand hasn't changed. What does that do for the price? Well, I mean, just think about it in your neighborhood. If you are selling your only house in the neighborhood, you got 50 houses in your subdivision, and you're the only house for sale, and you're the best school district in the history of mankind, your house is going to be in high demand as long as people can afford it. And what does that do? It increases the price. I mean, that's how demand and supply works. You have one supply, and we'll just say 10 people demanding access to the school district, to the hospitals that you're close to, living next to your old buddy Josh, because they love the fact that I do composting and things like that, and they love that smell. Anyway, so they're like, yeah, I want to live next to that crazy guy. So anyway, they say, okay, we all want to live next to that crazy guy Josh. So we love that. And so you got a dude. And so we're 50 people want to live in this neighborhood. There's only one house for sale. All right. Now you switch that around, and now, everyone says, I can't stand that guy, Josh, because the compost stinks. And so we're all going to sell the house at the same time. Now you got 10 houses for sale, i.e. the supply, and the demand drops off a cliff because maybe the school district went to hell in a handbasket, whatnot. I mean, demand goes down, supply goes up, prices go down. Demand goes up, supply goes down, prices go up. When it comes to bond yields, so China is flooding the market with supply, Demand hasn't theoretically changed. China's flooding the market. You would think we'd have an increasing interest rate because the price of the bonds would be dropping. Price of the bonds dropping means yields go up. I mean, it's just like this. It's like a pulley. Price goes up, yields go down, vice versa. And yet that did not happen. It's interesting. It did not happen. So China theoretically flooding the market with supply. It didn't increase the interest rates at all. In fact, the interest rates went down a little bit. So I just find it interesting. Let's see, Rob, not much. I get more of my 1 year CD. Yeah. I mean, a 1 year CD, I was paying what, 2.5. So so going back to that, so this is the exact opposite we were in 2009. Yeah, 2 3/4, says Rob. A 1 year CD at 2 3/4. Yeah, and Rodney says, I don't think China will do much more flooding because they need the money. I 100% agree. In fact, just going back to China and the Australian elections, I chuckled because everyone and their mom are saying India and China are going off of coal. One of the reasons that Australia actually went right as opposed to labor, which everyone thought, was because the mining areas, their version of West Virginia and Pennsylvania, who are typically union guys, went to the right. And one of the reasons for that is because they were coal exporters. And China is getting huge amounts of coal from Australia. So all these people say, China's getting off coal, getting off fossil fuels. No. And then secondly, what the current government in Australia did, the Republicans essentially, is they opened a controversial coal mining plant in some place in Australia. I don't know anything about the country, but they opened a controversial coal mining plant. And we got a guy from New Zealand on here every now and again. That'll be interesting if he pipes in. Anyway, but guess who's the owner of this controversial coal mining plant? It's India. Reality is funnier than the comic, man. I tell you, reality is, I just chuckle because the whole issue with coal, China gets their coal from Australia heavily. Thus, Australia needs to mine it. An Indian company needs coal for India because they need electricity too, just like us in the West. So the government passes I don't know about a law, but the opportunity for this company from India to open a controversial coal mining plant in Australia. The left runs against coal, runs against fossil fuels, and the people who they could think rely on the labor vote for the right. I love it. Anyway, so that kind of chuckled. All right, so going back to what was I just talking about? So here's the interesting thing. 2009, when I was at USAA, this was in the beginning of Obama. Geithner was the Treasury Secretary, chair of helicopter bill. Big A, you the one from Alaska? Is that you? Anyway, helicopter bill is dropping money, quantitative easing, 1, 2, 3, 4. So everybody and their mom, even your old buddy Josh, I'll never forget that. I said, keep your bonds short. Oh, New Jersey. Okay. Right on, Big A. We got another guy, something from Alaska. So right on. Anyway, so everyone and their mom, hey, right on, Steve. Go Bruins. Yes, sir. I guess Memorial Day is puck drop for this SCF Stanley Cup Finals. Oh, man. Sharks look tough. They lost last night, but they looked tough. They were dominating that game. They were in the St. Louis offensive zone probably 75% of the time. It was nuts. And they still couldn't get that final goal to get to tie it up. Anyway, so back then we had, everyone thought inflation was coming, and myself included, because, as Milton Friedman said, inflation is everywhere and every time a monetary issue, i.e. too much money. And so we all thought this. And so I remember we had at USA, we had a 2, a 5, and a 10-year fixed annuity. The 2 was paying 4.8, the 5 was paying 5.5, and the 10 was paying 6. And I remember like it was yesterday telling people, don't lock up your money. You want to keep it liquid, because as interest rates go up, you'll be ruined the day you locked in that 10-year 6% fixed rate. Biggest mistake I've ever made. I mean, literally, I look back, other than my own messing around with options, that was one of the biggest mistakes I ever made. But at least when I was messing around with options, that was my own money. But back then, I was not really guiding people. We were weighing the options for people about the annuities that we had. 10-year looked pretty good. At 6% guaranteed. Only risk was USA staying solvent. I just remember like it's yesterday saying, no, man, no, inflation. We're going to be, it's going to be Weimar Republic. And I'll never forget, going with this guy, we go on doing these seminars all up and down the East Coast, from West Point, my man Rich from Louisiana. And he, he's a West Point guy, so don't hold that against him. Because a lot of these West Pointers, they're not based in reality. It's a joke. Anyway, so look, but if we go around and have these debates in front of our seminar attendees about inflation versus deflation, and I always said inflation, he just said Japan, and it turned out he was right, man. It wasn't deflationary, but we certainly haven't seen any increase in interest rates. So going back to what I do on my cash, if you're locking up your money for 10 years and you're getting 2.3, and you get a 1-year CD at 2.75, like my man Rob W here is, does it make sense to lock up your money for 10 years? Well, inherently you say no, but then you start thinking, is 2.75 is that solid, or could that itself go below 2? It's just the exact opposite where we were in 2009. In 2009, everyone's worried about inflation, and we're like, don't tie up your money. You're going to get hammered. And we were wrong. So now I'm sitting there thinking, maybe you should lock up your money for 10 years and at least get the 2.39. At least you have that. And if the Fed funds rate, they lower that, then 2.75 will be fleeting. So it's a challenging time for the bond market. It's a challenging time, which is why I say keep it with CDs. Just go CDs and be done with it. Just don't do bonds. I just don't believe that you should in this day and age, because the CDs, at least they're going to be shorter term. At least they're FDIC insured, not quite as risk-free as treasuries, but at least you have access to them pretty quickly, and you can be nimble if things change. But with that said, we could come back here a year from now, and the 1-year CD is paying 1, and the 10-year treasury is still paying 2.5. And at that point, you're looking at the 10-year treasury pretty favorably, and you're like, oh, man, no. All right. We talked about that. Your thoughts on options for buying and selling of options. Yeah. I messed with options flying Illinois Class G. I messed with options back in the 90s, late 90s and early 2000s at Schwab. I was actually on the option trading desk. Selling covered calls can generate income. That's a fact. Selling covered calls can generate income and actually reduce your risk. Anyone who argues against that is just wrong. They don't know what they're talking about. Selling covered calls. And what that means, and I'm not this might not make sense how I draw this out. But let's just say you got, I don't know, we'll say XOM, that's Exxon, right? You got 100 shares, it's trading at 50. All right, so you got 100 shares, it's trading at 50, and we'll just say it's paying a 4% dividend. All right, so you get, a $4 dividend. All right, so for every 100 shares you get, but I said, because you have to have a round lot. So 100 shares, you get, what's that? You get $400. You know for a fact you're going to get $400 of income off Exxon. That makes sense. You got 100 shares. That's called a round lot. An odd lot is anything less than 100 or 105 or something like that. A round lot is 100. I got a round lot of shares. So you got a round lot of 100 shares. It's trading at $50 a share, and you're also going to get $4 a share of dividend income for the whole year. So what you do is you sell. We're going to use what's called a LEAP, a long-term equity appreciation. I forgot what the P stands for, but LEAPs are longer-term options. I think they're 6 months or more. I can't remember. But anyway, you're going to sell a LEAP that if the price goes to 55 or above, this is called a strike price. If the price goes to 55 and above, you will have the option. You'll have your stock taken away from you. It'll be exercised. That makes sense. So what happens here is you say, okay, I have 100 shares of Exxon. Right now it's trading at 50. I'm going to sell an option for 55. That's the strike price. If the price goes above 55, my shares will be taken away from me. But what will be taken away from me is it'll be taken away at 55. So I know for a fact, if this were to happen, that I will get the appreciation from 50 to 55, right? So that's a 10% appreciation, plus I'll get the dividend, whatever portion of the dividend I get. And so you're getting the dividend, plus you're getting the appreciation from 50 to 55. It's a wonderful thing. But here's your old buddy. Well, let me show you what else can happen. Why it's actually less risky first, and I'll tell you the mistake I made. So now we got 100 shares, and I'm just saying round lot is at 50, and we got 55 strike price, and we're getting a $4 dividend. All right, so going back to that again. All right, so what happens is, what was I going to say on that? So now what happens is, what happens if the price goes down to 45? Oh, I forgot to tell you too. To sell the option, someone's going to pay me money for that. I forgot to say that too. So someone's going to pay me, we'll just say $2 a share. I just thrown that up there. We'll say $2 a share for the right to take my 100 shares of stock of Exxon at 55. I have to give, that's called a premium. So in this case, if the option expires, i.e. it gets called from me at 55, I get a $50 to $55 appreciation. That's $5. I also get the $4 dividend. Again, we'll just say it took a year for that to happen. Plus, I get the $2 of the option premium. That makes sense. So I'm getting, all said and done, I'm getting $11 on a $50 investment because, again, I got the $5 appreciation increase. I got the $2 premium for the selling the option, and I get the $4 dividend. And it literally is this simple. I mean, it's not an issue. Now, what happens if the option drops to 45? Well, in this case, I still get the $4 dividend, and I still get the $2 premium. So I'm literally $2 ahead because my actual net loss is not 50 to 45, it's 50 to 47 because I have these $2 extra of income I made. Does that make sense? That's why it's less risky. So selling a covered call is less risky than actually owning the stock outright. That's just a fact. I mean, it's not debatable. Now, the problem comes in. All right, so I'll answer your question here in just a second, is that if that stock goes to 75, so now that stock goes to 75, I sold it with a strike price at 55, which means I only got a portion. I only got 10% of what was a 50% appreciation because it went from 50 to 75. That's $25 appreciation, i.e. 50% move, but I only got 10% of that move. Now, I did also get the dividend, and I did also get the premium of $2. So I'm still up. Don't get me wrong. I mean, I've still made a good holding, but I missed out on the upside. That's the best. That's the thing that stings with options. But let me show you what I did. And I'll answer some of these questions in a second. So what I was doing I'm telling you, selling cover call of dividend stocks makes sense. But look, I'm not the only guy who knows this. Everybody else knows it. And they got these machines and they got these what the hell is a Black-Scholes options? I mean, don't follow all that stuff. Is just silly. I mean, they got all these mechanisms on how to value options and all this. It's all based on spreadsheets. Human beings aren't spreadsheets. Our brains don't operate as spreadsheets, which is why all the best and the brightest, they don't have any advantage over you when it comes to investing, because it's all luck. It literally is. All right. And then it's called human emotion, the Dutch tulips, the madness of crowds and stuff like that. All right. So here's what I was doing. We'll just say I had an option and I was selling it. I got a $2 premium. And I sold at a strike price of 55. All right. So what I was doing is I got a $2 premium, sold at 50. I sold at a 50. I got a $55 strike price, and I got a $2 premium. All right. So now the price fell to 45, and I'd do it again. So now it's at 45, but now I'd make my strike price 50. I'd capture the $2 premium. Then the price went to 40, and I'd sell it for 45. Sounds pretty good in theory, right? 40 to 45, and I got another $2 premium, and it went down to 15. I mean, you can see I'm riding the option train down 15, and I sell it at an option at 20, the whole thing. All right. So what happens? This is a huge mistake I made. So now I'm selling at 15. I'm selling a strike at 20. The price is now 15 with a strike price at 20. And somehow the stock bounced off the ground and came back, and it was taken from me at 20. So my cost basis, my initial cost was $50. All right. I was able to capture these premiums, but the premiums weren't that much. And I was able to capture the dividends. But essentially what happens is ultimately I guaranteed a loss, a significant loss, because I sold the option on a declining value of the stock. And at some point the stock would come back up, and I lost there, and I got hammered. And I think I was selling on the Qs. And back then the Qs, I think it's the quadruples down. The Qs, the QQQs was the NASDAQ 100 index. And so remember, if you think about the NASDAQ, it was at 5,100 in January of 2000, or was that 5,100 or it moved beyond 5,000. I don't think it hit 5,100. I think it was actually 2000 March of 2003, if memory serves. No, I mean March of 2000. I think it was March of 2000. The NASDAQ broke 5,000 for like a fell off the queue, and I just got smoked. I just said I'm never doing it again. All right, so let's see what I have. Some of the questions on options on here. So I'm a fan of it. You got to know what you're doing. And the best thing on an option, my man from Illinois, is that if you have a stock that you think doesn't have much upside, then start selling options against it for sure to generate some extra income. Absolutely. But the minute it starts going down, maybe sell one or two on if it's declining. But I completely agree with my man Med Faber. Cut your losses. Something starts going. I was just telling one of my boys today. He's talking about stock markets. I mean, because he said, this is my 11-year-old Liam. He asked me about stocks. He goes, well, if the stock went down, 30, 40%, I just hang on to it, wait for it to come back to even. I said, that's human nature. I told him, I said, cut your losses, man. Just get out of that, because the stock doesn't know when you bought it. It doesn't care. It doesn't know. It's an inanimate object. You got to cut your losses, and not losing money is rule number one in investing, which means that the markets, this will sound, I'm a buy and hold guy, but if you have an individual holding and it's going down 10, 15%, cut your losses, get out. I got no qualm with that at all. Should you do that for indexes? No, just let the index work as magic. But for individual holdings, absolutely, because an individual holding can go to zero. Index is not going to zero, but individual holding can for sure. Let's see. What do you think about 72T to retire early, mid-50s? I don't think you need to do it, man. And the reason for that is once you separate from service at 55 or beyond, and if you're a Leo, first responder, once you separate from service at 50, you can get access to your money as long as it's in your 401k, 403b, TSP, whatever it is, without a penalty. So if you're depending on, if you're 55 and you separate from service today, you have access to your cash without penalty, not without taxes. If you're 50 and you're a first responder and you're separating from service, you have access to your cash without penalty, not without taxes. So you don't even need to mess with 72T. I just never been a big fan of 72T. I always thought it was a way for that and in-service distributions for stockbrokers and financial advisors to find ways to gather more assets that they could manage for a fee. I've always seen that because I've seen all these wholesalers come by my office saying, hey, here's a way to capture more assets. 72Ts, in-service distributions, lump sum distributions as opposed to pensions because they get paid on assets under management. And I think because that the 72T generally never did anything for me. I haven't seen it done that well. I've seen it a couple of times where it was bad, not good in terms of someone, they didn't do it for 5 years and they hit 59.5. They didn't think they needed to do it anymore. And you do. You got to do it for 5 years or 59.5, whichever comes later. Yeah, that's what it was. And so once they hit 59.5 and it's only been 3 years on 72T, they forgot to do it. Well, they got hammered penalty wise. I hadn't seen that much, but that is a risk that's just not worth taking, in my opinion. We don't have to worry when de Blasio becomes president. Shangri-La will be a chief. That guy. Did you hear about how he got he had his SUV got pulled over for all kinds of stuff, and no one reported on it. Tell you, man, the powerful. Look, it's not just Democrats, the Republicans too. Trust me, man. Republicans, they get by. It's just the powerful are the powerful, and we are just peons. Thoughts on AT&T with a 6% dividend yield and a PE of 12? I'd have to look at. Hey, my man, Texas Country Living. That's right. And so Eleanor McDougall, you should look up my man Texas Country Living. If I'm not mistaken, he does a lot of not maybe gardening, but certainly planting. I could have sworn my man Texas. So Scott, is that your name? He had a channel on if I'm not mistaken, he had some chickens back there. So that'd be a channel to check out. It just depends on the debt. Texas, Texas Country Living say AT&T has a 6.6% dividend yield and a PE of 12. The reason the dividend yield is so high is because the price is so low, which is why the PE is so low. And so this is a value stock. It's a large cap value stock, and this is why value stocks are riskier than growth stocks because the PEs are low for a reason. The dividend yields are high for a reason. And the reason for that is because it's riskier than a stock that has a high PE and a low dividend yield. The dividend yield is based on the price. That's all there is to it. A high price, a low dividend yield. A low price, a high dividend yield. So when you see a dividend yield of 6.6, and then you factor on top of that PE of 12, that there's risk inherent in there. So I wouldn't buy it. I mean, I'd buy it. I own. I can't remember what I own, the Vanguard Value Index Fund. I can't remember what the ticker is, VLV maybe, I forgot. And that I guarantee AT&T's in there. I would not buy it by itself, no way, unless I'm taking a flyer on it. And my mom took a flyer on Ford many, many years ago, and it paid wonder. That was when Ford was in the world of hurt back in the late 90s. And if I recall, she made a nice mint on that. And sometimes it does work to take a flyer on a value stock, but that's why value stocks outperform historically because they're riskier. Everyone seems to think they outperform because of high dividend yield. No, it's not that. The reason the dividend yield is high is because the price is so doggone low. I'm just telling you, man. I mean, it's just the way it is. I bet they got significant debt. I bet if you looked at their balance sheet, I bet the debt is out of control. And I bet their bonds, they're issuing debt in order to pay the dividend yield. And you can't have that, man. If they're issuing debt in order to get cash in which to pay the dividend so they can keep the stock listed on the New York Stock Exchange, for instance, because don't forget what happens, a lot of these stocks, once the stock falls below a certain value, is delisted from the New York Stock Exchange. If that were to happen, it's at that point, it's hell's bells. And what they'll do is one of the reasons they keep it listed because the dividend yield so high, very, very attractive. And with a high dividend yield, people start saying, whoa, that's paying a high dividend yield, and that it inherently drives demand. And the demand does what? The price increases the price, which is what's happening here. Now, the problem is where's the cash coming to pay the dividend? Because the dividend is just a reflection of the price of the dividend yield is just a reflection of the price of the stock relative to the actual dividend it pays. So the dividend it pays is the actual cash that has to be generated from someplace in which to put that dividend in your pocket. Where's that cash coming from? Is it coming from operations of the company, profitable operations, or some companies will issue debt in which to finance their dividend? And the reason for that makes sense because the debt they can write off, it's a business expense, so they can write that off on the bottom line. You as a shareholder can't write off dividends, and neither can the company. It's a profit. So what happens is dividends are double taxed debt is not. So a lot of these companies thinking they're being sneaky with the tax code, and some absolutely are saying we are going to issue debt in order to pay a dividend. I don't think that's necessarily a good idea, because I don't think you should be issuing debt at all. You should have dividend out of profits. So I don't know what's going on with AT&T. I see a 12 PE and a 6.6% dividend yield. That just tells me there's a significant price decline that they've had, and I'd want to know why that has happened. And if I look and I see that there's balance sheet says they had $1 million of debt 2 years ago, now they got $5 million of debt. Well, that tells me they're using that debt and they're not, well, they're profitable, but they're using that debt. I don't know what it'd be for. Growth? Is it buy out DirecTV? I don't know, but that scares me. My man Jeff says, if I put $50K in a regular 1 year CD and discover 6 months down the road I need to get the money, what? Okay. So if I break my CD, my 1 year CD before the term, well, at least get my $50K back. It just depends on the issuer, Jeff. A lot of times it will. A lot of times, as long as it's been over 3 months. So what happens in my banking days is that you have a 50,000 CD, and let's just say it paid you $1,000 of interest every 6 months. That'd be $500 of interest. What they say is, if you break your CD, you're going to owe us $500 of interest. Does that make sense? You're going to owe us 3 months of interest you would have accumulated. If you hadn't quite accumulated that full 500 of interest, it would come out of principal. So if it's 2 months in and you've only accumulated $400 of interest and you want to break your CD, they would take their interest plus they get another $100 from you from principal, because you hadn't had enough interest in which to pay the 3 months penalty, if that makes sense. I don't know how banks do that anymore. My presumption is they probably do 6 months of interest at this point. So I bet if you had a $50,000 CD, and you're getting 1,000 of interest every 6 months, they're probably saying if you break the CD within 6 months, you're going to have to pay $1,000 back to them, be it your interest or part of your principal. Once you go beyond the 6 months, you're probably going to be fine, I would think. But it depends on the issuer for sure. I hope that makes sense. Can I trade options in 401k? Yeah, if a 401k offers it, a lot won't. A lot won't offer it, but if they do, Ronnie, absolutely. If it's offered, it's just I highly suspect the vast majority of 401ks will not offer option trading, and the reason for that is because of liability. The 401k provider, do they got a fiduciary role? It falls under ERISA, the Employment Retirement Income Security Act. Any kind of employer-sponsored retirement plan. I don't know if they had a fiduciary role or not, but I don't remember. But anyway, either way, the facts are if they don't offer fee conscious stuff, diversified portfolios, if they don't follow the basic premise of what's called modern portfolio theory, diversification, low fees, the employee is going to sue them. I mean, they can sue them for not taking their, I don't know if it's a fiduciary role, but their role seriously at providing retirement security. So I would bet the vast majority of 401ks do not offer for option trading. So if you were going to do that, you need to roll to an IRA. Jeff, right on. Okay, no, that's Texas saying, Jeff, you pay a penalty. Yeah. Let's see, I missed something here. Sweet, sitting on almost 100K in savings account. I'm tired of it, just sitting there. Yeah, I hear you, man. Hey, Josh, Mark W. from Georgia. Right on. Where is Cochran, Georgia? About stocks, young man. What about the root system of the plants? Eleanor, you pulled my leg. Yeah, so tell Jeff says, tell my son I lost 100% of my investments in the 90s waiting on Value America stock to rebound. Yeah, cut your losses, man. The Babs Cast, great videos. Any thoughts on angel investing? I don't know much about it, my friend. I'm not sure I know what it is, but I don't know how you'd incorporate that. There's a guy named Paul Wheaton out of Montana who does rocket mass stoves, a lot of permaculture stuff. And then, that's everyone thinks it's sad actually, because hate to even use the term organic because it's so cliched anymore. Beyond organic is what permaculture is, or using the nature, what as a Christian God has provided to us, and using his abundance and caring for his world. And that's me. That's not the permaculture or organic, heaven forbid, community, because a lot of these guys are atheists. But anyway, Paul Wheaton's a guy, and I like him quite a bit. And he does Kickstarter stuff, right? And his Kickstarter stuff is on taking his ways to generate heat, ways to generate cooking, just different ways to do it without using electricity and stuff. And with I'm not even gonna say renewable. It's not renewable because he's burning wood, an efficient way, rocket mass heaters and stuff like that. And so he has a Kickstarter campaign, which I contribute to because I actually find it incredibly fascinating. I love the work that guy's doing and all those folks up there in Montana. And that's an angel investing to some degree. Now, do I spend a lot of money? No, but you could. I mean, there's all kinds of people who need Kickstarter stuff who are doing wonderful things. I'm telling you, there's a guy named Mr. Teslonian. Mr. Teslonian, I don't think he's out of Texas, maybe Arizona, but someplace out west. And his YouTube channel is fascinating. It's incredible. I love it. If he ever were to bring to market a wood gas, what's called a wood gasifier. So where you're basically you're taking wood and turning it to electricity. You're burning wood in a very efficient way and turning it to electricity. It's not easy for just a layman to do. And I actually bought a book on how to build a gasifier. There's no way I'm gonna ever set the time to do it. I don't have enough patience. But if my man, Mr. Teslonian, were to do that, and this is just the way I look at it. And he would fund a Kickstarter thing. Hell, I'd be on there 2 seconds flat, like white on rice. I'd be like, man, I'd love to be an angel investor for him if he's going to bring that to mass, where I can just kind of plug and play. Whatever, I don't know. There might be some lady in Zimbabwe who's trying to, learn a new farming technique for cocoa beans or something like that just doing a Kickstarter. I mean, that's the angel investing for sure. So I'm a big fan of that kind of stuff. I just don't know how the angel investors as of Silicon Valley does. I don't know. Well beyond my pay scale, unfortunately, or maybe fortunately. Let's see. Canes fan. Yeah, take that. I'm just joking, man. How do you factor in military retirement into planning, meaning a 30,000 year pension, 20 years is the same thing as that. Okay, that's a great question, my man, Canes fan. And I'm presuming you mean Carolina Hurricanes. You actually just occurred to me. You might mean Miami Hurricanes. And then we'll remember what happened with Maurice Clarett in Miami. Miami, I can't stay in Miami football. Always hate Miami football, but they got robbed in that NCAA championship in was it 2001? Let's see. Hey, Lisa K. There you go. All right. So the problem with a military pension, just want to make sure my door's closed. So the problem with the military pension is it does avoid some of the typical techniques we can do for tax planning before you take Social Security and before you're on Medicare. And the reason for that is, and I know you got TRICARE, but you're still got Medicare Part B once you hit 65. The reason for that is because you have that pension, and that pension automatically at $30,000 a year automatically puts you at the very minimum in the 10% tax bracket forever. You'll never be in a 0% tax bracket until the standard deductions go up to $30,000. So because of that, we have some tax limitations when you have a pension. It's a good problem to have, my friend. Don't get me wrong. It's a good problem to have, but that's a drawback about the pension. I think this gets overlooked a lot. I overlook it. But the minute I started doing tax plan for folks and I said, you got a pension, it's a great problem to have, but it does limit our ability to do, some serious tax planning. Now, if you're married filing jointly, there's other tax planning that can be done, but it's not quite as pretty as some without a pension from 62 to 70. And I've done videos on that. I'll do more on that as we go forward, but just keep that in the back of your mind. Your military pension is a bond. I mean, for the love of God, man, the love of the good Lord, the military pension is a bond. So just like you said, you got $600,000, you're generating $30,000 a year. The military pension is the equivalent of a $600,000 bond fund. That's just what you got to look at it without question. So if we take 30 into 600, that's a 5% distribution yield. And I mean, obviously that's just saying you live for 20 years. I get that, but still that is a bond. And so Social Security is a bond. Your military pension is a bond. I mean, if you have TSP, why would you have any of that in G fund or the F fund? It's just my opinion now. Just my opinion. I mean, you already have your Social Security, you already have your pension. I mean, that's basically $60,000 of bond income. They'll never go away. And so all these people say, well, I need to be 50-50 stock to bond. So my 300,000 TSP, 150,000 will be in the C fund and 150,000 will be in the G fund. I said, man, don't do. Well, I mean, again, it's up to you, but you already have the bond side covered. So I'd be looking at that stage as being as aggressive as I can on the TSP. Hope that helps. The policy turns back. Oh, a politician turns back on New York City? Never. I mean, on his constituents. Of course, you knew what you're getting, my man, the Babs cast when he voted for that guy. I mean, come on. I mean, he's a socialist as socialist is. Miami Canes fan, right on. Okay. So you got to admit, look, I hate Miami, and I was going for Ohio State, but when they called that pass interference in the end zone, that was nuts. All right. Thanks for answering my options questions. You got it, my friend. Harry Chu. I remember when money market accounts were paying 6%. Oh, geez. Yeah, man. Will we ever see that again? We could, I mean, who knows? But don't forget, now we got the break the buck thing on the money market accounts, my man, Harry. Money market accounts, that means they can drop below $1. Not likely to happen, but certainly can. And if it does, there was the federated money market account. No, it wasn't federated. The first one that did that is a big one too, back in 2008. I can't remember, but anyway, it broke the bank. It broke the buck, and that really, really hurt a lot of people. Hurt a lot of people saying, "Whoa, what is going on here?" So I don't ever see money market paying 6% again, because whatever the rules were that allowed them to maintain the dollar price per share, those rules are gone. And for them to stretch out that kind of yield, it's no way. I mean, who could happen? Janet Johnston, it might be better to take a several CD. Janet, I don't have any qualm with that at all. Going back to Jeff Raines' question though, 100,000 sitting in cash. Here's a perpetual question. I get 2.75 on a 1 year, and I get 2.8 on a 5 year. What do you do? Well, the rule of thumb would be you take the 1 year, because it's paying just about the same as a 5 year without locking up your money. But what happens if the 1 year, when it comes to matures, is now down to 1.2? You'd be loving if you still had that 2.8. I see, that's the issue. So I kind of agree with Janet. Maybe doing Jeff, five. It sounds like a pain in the ass, but 5 20-year CDs, 1, 2, 3, 4, 5, $20,000 a pop, or maybe 4 at 25 a pop or something like that. Speaking of which, just while I'm thinking about it, because someone's name rang a bell. If you're a subscribe member of mine, a Subscribe Star member, where you're paying me that $10 a month thing, and I appreciate it. If I don't have your email, please email me so I can send you the code to download the audiobook, both my audiobooks, for free. The Amazon audio team, Audible? No, is it Audible? I think it is Audible. Somehow they gave you these free promotion codes to use to give to people for your audiobooks for free, which it seems like I said, oh, that's kind of cool. So if you are a Subscribe Star member, and I will not do Patreon, but if you're a Subscribe Star member and you're paying me the $10 a month thing, and you want the audiobooks for free, just make sure I have your email. And my man, you know who I'm talking about here. I have your email, so I'll email that to you tomorrow. But I have a few Subscribe Star subscribers, and I don't know if I have all of their emails, so keep that in mind. Just as an FYI, a shameless plug. The reason I do Subscribe Star, and that if you go on Subscribe Star and you want to support Kickstarter for me, essentially, it's $10 a month, and you look, man, do whatever you want. I don't care. But you go $10 a month. I don't. I will, when I finish up my next book, you can retire on Social Security. I'll send it to you. I'll mail the hard copy to you for sure. Any books I'll get out there to you. One of these days, I'll probably start a newsletter for my Subscribe Star supporters, if you will. It seems like, then the audiobooks for sure too. Seems like I had something else I want to say on that. But I do have a Subscribe Star thing. I don't really talk about all that much because I always forget. But it's just subscribestar.com/Josh Scanlon. It's just $10 a month, and I can't guarantee you'll get $10 a month of content out of it or value. I don't know, but the way I look at it, I subscribe to some other people as well. I support them just because I like sticking to the man. And Patreon, friggin' losers, they banned guys who were not bad people. And they just banned them. They got in the cahoots with PayPal to ban people they felt were just what's going on here, man? I was sitting there thinking, look, you might not like Alex Jones. I don't even care about Alex Jones. He's weird, but who cares? If you don't like him, don't buy it. What is the deal? He's not freaking out there with a freaking gun to your head, showing videos of people getting decapitated and saying if you don't follow this certain ideology, that's going to be you. He's not Antifa. What is this? It's nuts to me. I don't get why these people are so dominant and yet they so control everything. It's nuts, but it's great because they're taking a lot of left-leaning people, making them libertarians, which is great. They're taking a lot of right-leaning people, making them libertarians, which is great. So for freedom, it's wonderful. The more these people from the government and just the powers that be act like this craziness, all they're doing is they're taking off the people to make them say, to take the red pill. It's great. And that's wonderful because that means we don't have to be right or left, the false dichotomy of the Republicans are right, the Democrats are wrong. Forget that. And I always say, okay, you got a political structure, and this is what they teach you in stupid political science. You got left and right. Communism is left, fascism's on the right. Okay, so that means if I'm for freedom, where does that go? Well, you're going more to the right, so I'm going more to fascism. Fascism is free. Oh, no, you're going more to the left. Communism is free. Where if I want to be in freedom? Well, just let the hell you live with your life. Where does that go? Well, it goes up here. So you're all living, the false dichotomy is this two-dimensional thing. I'm like, no. I want a three-dimensional thing. I don't want to be part of that. Anyway, so Subscribestar, they initially were taking, I don't know if it's PayPal or something like that. All these guys are getting cahoots, man. It's nuts. And Subscribestar almost lost, but somehow they're able to get their technology to work and they're able to take funds. So, and there you go. Look at Subscribestar if you're interested in donating to freedom-minded people, and I'm on there as well. So, all right, so let's see. That's my shameless plug. Should you use trailing stop losses in your IRA or 401k? I don't own any individual stocks, my man, Daryl. So no. If you own individual stocks, absolutely. You just cut your losses 10%, 15%, whatever you want to do. I completely think if you have an individual stock and that sucker's dropping like a brick in water, you need to get out of the position. I don't have any qualm with that at all. I have no individual stocks. Just FYI. But if I did, I'd put stop loss on there for sure. Absolutely. Just because I don't want to get hammered on it. We've seen Bethlehem Steel. We've seen all these companies throughout time go bankrupt time and time again, and people lost everything for sure. So I think the answer is that. I don't even know if you can do it on ETFs. I don't know. I don't do it. And the whole point about ETFs and index funds is that you're so diversified. You're going to get the vagaries of the stock market no matter what, but nothing's going to zero unless, we get nuked, and then who cares? You still going? Yeah. Oh, yeah. Hey, Doug, my man. Yeah. So this, yes. So my man, Doug Edwards asked me about going live with Dustin on the date is, so my man over at Jazz Wealth, Dustin Tibbetts, who I love Dustin. He's such a good guy, is on May 30th. Yeah, May 30th, Dustin and I will be going live. I think what we're going to do is we're going to do a video at 1, I think is what he said, or something like that. Go get a late lunch, and then we're going to go at his office down there in, where the hell is he? He's in someplace in Florida, Seminole, Florida. And then we're going to go do his stock market closing thing live at 5. So I'm glad you brought that up. So Dustin and I were talking the other day. If y'all have questions that you want us to entertain, we can kind of we're literally just going to go off the cuff. We don't have any formal thing. But Dustin said, "Hey, ask your audience. I'll ask my audience if they have questions. If anything jumps out at you, man, by all means, let us know." But we will be live for the thing at 5, his stock market thing, and then I think we're also going live at 1 if memory serves. But it'll be fun. Dustin, good guy. So thanks for bringing that up, Doug. And Jazz Wealth is his channel. Dustin, I just like the guy. There's no other way around it. There's guys I don't like, and there's guys I do like, and Dustin's one of the guys I like. And I like his YouTube channel. I watch it. I don't want to say religiously. I probably watch 3 or 4 videos a week of what Dustin talks about, and I think it's good. So his YouTube channel is Jazz Wealth. just Jazz Wealth. And so Dustin was actually a mentor of mine when I started my own YouTube channel. So yeah, good question. Ronnie said, yeah, there might be a local club about angel investing. Yeah, right on, man. Couldn't agree with that more. TSP and G Fund. I just think, given that you got Social Security, my man, and given that you have a pension, that's way too conservative. But don't hold me accountable. That's up to you, my friend. I used to get 6% on my PayPal balance. Whoa. So if you had money in PayPal, Rodney, they'd pay you 6%. Damn. Hokey, says my man Jeff. Yeah, so you don't like Miami Hurricanes either, Jeff? I tell you, man, hey, this is back in the day. Remember when they had like Irvin and all those guys and Bernie Kosar and whatnot? Remember when Boston College Flutie played Miami? And they had the convicts versus the Catholics versus the convicts. I've always been, I'd never liked that. I've always thought these are, a lot of these guys are football players, and the idea, I've always been offended by that. I'm not going to lie to you. The idea, you don't know who these people are, and they're playing football for your entertainment, to call them convicts. That always bothered me. Miami always had the rowdy guys. I get that. And some of that was a little bit over the top, but they're good. And if they're good, you have to hate them. That's kind of like why everyone hates the Pats, because Tom Brady is so flipping awesome as a GOAT. And he can't be stopped. All right, so they're stealing vids. He is stealing my vids, so let's get rid of him. All right, so stealing vids does not like me. Why you got to be stealing vids? All right, I don't know if y'all saw that, but let's see. So Lisa, it's an attack on the right, and it's not even just the right though, Lisa. It's attack on just free thought. It's not just whatever the hell the alt-right is. That's what I don't understand. I'm like, it's just, and if you think it just stops there, you're crazy. My thing though is Antifa is bad, and they're out there saying whatever the hell they want to say. And then anyone else is out there is like, what is this? I mean, it's crazy. Why is Antifa allowed? I can't stand those guys. That's all there is to it. And but I think if you're promoting violence, as Antifa does, you have a right to shut them down. If you're just promoting weird stuff, I don't know, alien, whatever. I don't even pay attention to Alex Jones. I don't even want to, say like everybody else. I don't care. I literally don't care. But just who cares? Is he promoting violence? I mean, if he isn't, I don't have any problem with that. But Candace Owens, what the hell? I was sitting there thinking, how nuts. You are the only YouTuber I support because you use Subscribestar and I gave up PayPal. Yeah, I'm going to have to get rid of PayPal too, Jeff. It's so easy now, but off the top of my head, I haven't looked at an alternative. You can't support these guys who don't support freedom. And I mean, I know, well, I'm just taking advantage of the platform. Well, YouTube YouTube's been good to me. PayPal, it's easy. I get it, but that's they got together in cahoots, all those guys together, and they banned people they didn't like. And we know this for a fact is happening between you and me, everybody here. I was talking to a guy, let's just say he worked for one of those big firms, nicest guy in the world, nicest guy. Just, he and his wife getting by, just, with a kid, just freaking nice people out there. And just, we talked about the guy from Google who owns YouTube, who talked about how Google was censoring quote unquote male voices, and this guy, he left because he said, I can't stay here anymore. And this guy is not a rabble rouser. He just says, I can't stay here. And now he's making $30,000. I don't know, flipping burgers. He's comfortable with it because he doesn't have any debt. Yeah, that's why I was going with my self-sufficient thing. I didn't care about the gender identity stuff. I think my man Ari, who I like, who's a big lib, but I think he's a good guy. Or maybe a lady. I don't know. But I was just using that for the example, is that when you're stuck in corporate America, Google is a perfect example of that, and they start doing things that offend you in terms of who you are as a human being, you go along for the ride if you don't have any other option. And the way to not have any other option is not to have any debt, or at least have enough pile of what I call FU money to walk out. And that's what my man who worked at a company out there was able to do, because he had enough FU money and he also didn't have any debt. And I just I'm telling you, man. And when USA started going down that road of you can see what's happening here. And I haven't been there for 2 years, so I don't know, but I know people who's still there. And you can see that ship is turning, and it's not turning to the right, it's turning to the left, because, the greasy wheel gets the squeaky wheel gets the grease. And for me, it was that plus the commute. And I said, I just don't want to do this anymore. And it's wonderful. It's wonderful to be able to escape, but I know a lot of people can't. They got to keep their mouths shut, put their heads down, and drive on. And I got nothing but respect for doing that, without question. But if you can avoid that by not having debt, so you can get the hell out of Dodge, I just think you should. But I'll leave that again up to you. Let's see. Hey, Harry, my man Harry in the house. I consider getting more aggressive. That's what I think you got to do, man. I think you got to do it. Just remember. All right, just let me be clear, though. For every $100,000 in the C fund, you were not down just 37% in 2008. You were down 53% from October 2007 to March 9th of 2009. So if you had $100,000 in the C fund, you lost $57,000. You were down to $43,000. It's easy to say you should get more aggressive. And now, will that time ever happen again? I don't know. I mean, it was in 1973 and 74, the markets lost 16 and 24% or something like that, 40%, 43%, I think. Obviously, the Great Depression. But I don't even know what, from 1972, when the market started to crater. I don't know. That might have been in October 72. I don't know. But at least in 73 and 74, the markets were off 43%, which means if you had $100,000, and this is just price to, I guess it was including dividends too, you were down, in that case, $43,000. You're down to $57,000. In 2007 to 2009, you were down $53,000. The G fund was up. Government bonds performed well during the Great Recession. And so it's easy to say from a technical perspective, and again, a spreadsheet warrior here, I just be aggressive. Remember, man, you're going to wake up one day and that sucker is going to be down 20%. Easy. $20,000 for every $100,000. Can you handle that? And if you can't, it's no big deal. I'm not going to yell at you. But that's what you got to put your head around. Especially if you're married. I'm just telling you right now, man, if you're married and your wife, I'm assuming you're a man, if your wife is sitting there saying, hey, we got $300,000, and you're like, well, I just listened to some crazy guy on YouTube says I should go all in this C fund. A, I didn't say that, but B, let's just say that's what you're thinking. And you put your $300,000 in C fund, and that happened to be October 2007. Fast forward to March 9th of 2009, that $300,000 is worth $100,000. It's not a good place to be, brother. That's not a good place to be. Your wife is breathing down your neck saying, what the hell? You're like, well, I got a pension and I got Social Security and that's a bond. And she's like, but you're only 55. Social Security is still at least 7 years away. But don't you get it? It's the bond. It's just, I'm telling you, man, you just got to go in there recognizing that stocks are risky in the short term. They're risky in the short term. And why do I say that for the third time? They're risky in the short term because everyone says stocks for the long run. I cite this book all the time. Stocks for the long run. Stocks are safe in the long run. No, they aren't, because the long run never comes. The long run is always out there. We're always in the short run. Stocks always fall, have a chance to fall 25%. It happens every 3.5 to 4.5 years, but it's completely random. There's no pattern. There's no up, down, up, down. It doesn't work like that. It's completely random. We just don't know. We don't know. So everyone says stocks are long. So you say to your wife, honey, stocks are safer in the long run because historically, blah, blah, blah. If you hold it for 10 years, blah, blah, blah. The hell's that? She's like, that's great. We're down to $100,000 on 300,000. When's the safety coming? Because I don't feel safe now. I'm just telling you right now. So stocks aren't safe in the long run because the long run never here. It's always the short run. Now, what I'd argue is, all right, this is what I think a lot of people miss the boat on. I can't tell you how many people I've heard this in my career. They might have 1998. Let's say in the end of 1999, they had $1 million. Fast forward to March of 2003, they have $600,000, something like that. I should have sold at $1 million. I've heard that 1 million times a Sunday. You're like, okay. And so basically, what they're doing is they're putting their their top peak of what they had, and they're using that as their benchmark for where they should have been or they could have been and stuff. And I wish they would not do that, because I'd say, okay, where were you at in 1998? I was at, let's see, probably $650,000. So why did we say when I was at $1 million, now I'm at $600,000, I should have sold, and that's where I'm down $400,000. I've lost $400,000. I say, yeah, but where were you in 1998? You're down here. So went up and went down, and now it's since come back up. The issue in that regard is you just got to recognize that, it's going to happen, and you have to have the intestinal fortitude to deal with it. That's all there is to it. And if you have the cash, either through CDs like my man Jeff's talking about, or if you have a pension and Social Security on top of that, that should give you more ability to hang in there when the market collapses, because it will, and there won't be any rhyme or reason. It just will. I actually have a question. Does the government use gross or taxable income when it comes to Roth IRA? I think it makes too much. Jeff, it's gross. Is it modified adjusted gross income? Let me look at my thing from Ed Jones. Actually, Ed Jones from Walters Kluwer. But a guy from Ed Jones had given this to my beautiful in her tax office, and I stole it. Don't tell my wife's boss. All right, so let's see. The Roth IRA, man, Jeff, why you got to embarrass me, man? I don't. It's taxable? No, actually, I don't know. Roth qualified retirement plan, Social Security. Anybody know? I don't know. It doesn't say here. It just says, I don't see it on here, man. I don't see it. That's crazy. Oh, there it is. It just says contribution limits, but it doesn't say. It's adjusted gross income, modified adjusted gross income. So it's not tax, not before your standard deduction, if that makes sense. My man Tom, most 401k plans only allow for funds to be purchased and not individual stocks. If you decide, if you decide to sell a fund, you must sell before the market closes in order for the sale to take place that evening. That's right. Yeah, good. That's a good point, Tom. Major Tom. So basically, what he's saying is, if you have funds and not individual stocks, you got to put a trade order in. Market closes at 4. You got to put the order in at 3:30 for it to execute at 4. It won't execute right then. You got to put it in. If you put it at 10:30, it won't execute until market closes at 4. And what I say all the time is my preference is don't put the trade order in the night before, just because it's just a pet peeve of mine. Not a pet peeve. You just don't know what's going to happen in overnight markets. And so if you put a trade order in at 11 p.m. at night to sell or whatever it is, and then you wake up the next day, you forgot you had the trade order in, and that sucker doesn't execute till 4, and all of a sudden JFK gets shot. That could be bad. So don't ever put a trade order in the night before. And for mutual funds, it's not a huge issue, but just don't do that. Stormy down here in Austin. All right, I'm sorry to hear that, my friend. I guess that's it. Oh wait, we got more. Here we go. Cool. Thoughts on Tesla? I just no. I wouldn't buy it. I don't. But again, I don't own any individual stocks. The hype on these guys are. Now look, man. I know electric cars. You go to a Tesla 0 to 60 in like 2.5 seconds or something like that. I've never driven one, but I hear they're freaking awesome to drive. I hear they're awesome. But how do you get around the battery stuff? I just don't get it. And I always chuckle. You had a 110 outlet here. How long is it going to take to freaking charge that battery on 120 volts? You know what I'm saying? I know they have these battery things where you can do it like you. I don't even know what it is. I don't know. But I just, at the end of the day, I sit there and how's this going to work? Where are you going to charge a battery? I don't know. And the thing about the convenience of vehicles is that they're convenient. So I don't know. The thing that ticks me off about the anti-Tesla people is now they're all. I was reading an article today that like Tesla, something on their self-driving car killed somebody. I don't know what it is. I said, man, that is coming. And as much as Elon Musk, I think he's a little bit of I don't know. Remember the guy from Simpsons? Monorail. That's why I look at Elon Musk to some degree. And of course, the media loves this guy. But at the end of the day, I like the fact that, he is bringing some new way of thinking. I just don't think Tesla, but the idea, by the way, that Tesla, you're going to have these rooftop PV panels for your shingles. It's, I look, it's fantasy world. And people get mad at me like, well, people need to try to do things different. I'm like, I get that. But I mean, should you invest in that company? I don't think so. That's just my own opinion. I don't know. Where's it going to come from? I just still, at the end of the day, the convenience of, I think it's just started raining here, Harry. The thing, no, maybe it wasn't. I guess a car going by. The convenience of your vehicle. You get in your vehicle and you drive. What if you got to get in your vehicle and your battery's down? It's like I use an electric vehicle to mow my yard. The batteries get older. The depth of discharge, it reduces its ability to retain a charge the more you use it. I don't know about Tesla batteries. My electric lawnmower battery is a lithium battery, so I imagine it's the same thing. The more you use, the more you draw the depth of discharge, the lower the battery capacity can be for the future. And so right now I got 4 freaking batteries to mow my yard. It used to just be 2. And the reason for that is because those suckers get old. And I love them, and they're great, but they go down. Hell, I have 3 batteries. All 3 of my batteries went down, and I still had like a quarter of the yard to mow. And it took, 4 hours to charge those suckers. I can't remember how amp hours they are. But anyway, and so I've quartered my yard up. Look stupid. So anyway, what digital banking platforms do you prefer? Cash? I don't know what those are, my friend. Butte Ween says Cash App or Chime. I'm ignorant. Sorry, bro. No debt's the best freedom you can have. I agree. Bruce, my man Bruce missed a start. Actually, so along those lines, my man Bruce, not Bruce, but it's getting a lot of people, actually a lot more Leos who don't pay into Social Security than I would have thought. Actually, I must have received 15 emails and a whole bunch more comments on the video I did on law enforcement officers with Social Security. I was looking like a guy emailed me from Jacksonville Sheriff's Office. They don't pay into Social Security, but they do pay in Medicare. I got a lot of emails on that. So if you are a law enforcement officer, I highly, highly suggest you find out if you're paying in Social Security. Because I did an article on this where a guy was like, I didn't know. And essentially the guy was kind of whiny. No one told me. And I was like, dude, you're an adult. But I mean, anyway, at the end of the day, if you're in law enforcement, and I'd say any kind of first responder, I would check to see if you are paying into the Social Security system. And you will know. Your FICA is 7.65. If 7.65 is going to FICA on your W-2, what is it? Not the W. Yeah, W-2. No, W-2 is what your tax form is. Whatever your pay stub is. I guess pay stub. Anyway, if it's on your pay stub 7.65, you are paying into Social Security and Medicare. 7.65. If you don't see 7.65, we only see 1.45. That means you're only paying in Medicare. And I don't know how, it works. I just don't know, but just keep that in mind. I was surprised how people emailed me to say, no, they didn't pay into the system. I was like, really? I always thought is only teachers predominantly who didn't pay into the system for Social Security, predominantly in Texas, parts of Georgia, parts of Virginia, and there's a big state I'm missing too. But I think each contract is different for your situation. Does that make sense? I don't know how it works, but I think, Illinois teacher, there you go, Corey, right on. I think each contract is different. So double check to see if your contract does it or not. It might be through your union. I don't know. But like Corey just said, Illinois teachers don't pay into the system, Social Security system. Single, no debt. Thanks to the opinion. There is risk in everything. Oh, dude, if you're single, my man, Miami Hurricane fan, if you're a single, no debt with a pension, TRICARE for life, and you've been paying in Social Security, hell, bud, you can definitely take the risk of going to C fund. Absolutely. 100K sitting in a credit union account near retirement in 2 years. No. My man, Derry Bullock, he's got 100,000 sitting in cash. We're retiring in 2 years. Look, I don't know what your expenses are, but let's just use $50,000. I love having 2 years cash. Did I say I love having 2 years cash? So if you don't have any other money, that's a different story. But man, having 2 years cash just makes sense. In that case, I wouldn't mess with CD. The share savings account is probably paying just as much as a CD over at the credit union anyway. But if it's not, then go to CD. Absolutely. I mean, literally, credit unions are insured by NCUA, the National Credit Union Administration, or something like that. The FDIC is for for-profit banks. So if you have a share savings account is only paying 0.25, then hell yeah, do buy a share certificate for sure. Need a Husqvarna robot mower. Really? You gotta send me a picture of that sucker, Jeff. A robot mower? Like, meaning you don't do it, it does it all for you? Oh, that's what I'm talking about. Going back to the self-driving cars. That's what I love about Tesla. Self-driving cars are coming. See, I am not one of these guys who likes to car. I don't mind driving. You can tell I do all kinds of videos when I'm driving my car. I would love to be able to dial up on an app and have some freaking robot pick me up to take me to the freaking baseball game. I would love that, man. I'm telling you, it's coming. People renting their cars. It's coming. I can't wait. And we're going to be safer. We're going to be living longer when robots are running these vehicles. I'm telling you right now. But Josh, Tesla had some guy killed. Yeah, it sucks. How many people killed in the time that Tesla had some guy killed, though? I mean, how many people die on the highways every year? I can't wait. Yeah, I don't know much about M1 Finance, Chris. I hear a lot about that. I just don't know anything about it, so I can't comment. So sorry. My man Corey here introduced me to not Right Capital, Personal Capital, and I did a video on it a long time ago. I haven't done a video on it for a while. Personal Capital is more for budgeting and retirement planning. I was pretty fond of Personal Capital for that. In terms of investing platform, I don't know. Corey can speak to that. Does personal, or anyone can, does Personal Capital have an investing platform? I don't think they do, but I don't know anything about M1 Finance. I've heard enough of it. Seems like a good place for sure. Is a 4% rule too high because rates are historic? Man, good question, Bernie C. All right, so Bernie says, is the 4% rule too high because rates are historically low? And the answer to that is yes. I don't have my thing. If we're looking, given the rates on the 10-year Treasury is significantly lower than it was when the 4% rule was concocted, we should be at a 3.2% rule. Absolutely. That's a great point, Bernie. Absolutely. I just say 5%. That's what I say. And I say 5% for a couple of reasons. One, the 4% rule is based on what's called the safe withdrawal rate. How much money, the most amount of money you could take out without running out of money ever, over like a 35-year time frame is 55. We'll just say 60, 40 stocks to bonds as rebounds every year. Taxes nor fees were considered, all right, which would add to the 4% rule when you factor in fees and taxes. But anyway, 4% rule. So if you say, okay, 4% rule, also had a 40% was in bonds, and back then the bonds were paying 5.5. On top of that, the stocks, the PE ratios were much, much lower than they are today. So theoretically, stocks are highly valued, bonds are highly valued. So all that stuff being factored in, we'd have to use a 4% rule to be 3.2. Inflation was higher then than it is now. So you could argue, and this is the whole thing about the 4% rule is like, okay, what if we throw inflation in there? Well, it's just the whole thing. So what I would suggest is that if you look, though, if you're willing to take a little risk, that i.e. you might have a few years where if you ran the Monte Carlo analysis that you had a chance to run out of money, is actually you could take like 6%. Michael Kitces did this thing on that. I said that I think the average 50% of the time you had money, 50% of the time you didn't. It was like 6.5 or something like that, or 6. Don't quote me on that, but it was over 6 or 6%. In fact, the vast majority of time, I think it's like 75 to 80% of the time, if you took 5% out, you're just fine. And that's even more modern with the interest rates been historically low as they are. So don't forget, with the low interest rates is also low inflation. So they got to kind of weigh each other. I say 5%, and I just use that as a number. And the reason for that is because you're not going to spend. Well, a couple things with the 4% rule, which frustrates me. Not Bill Bengen coming up with that. I'm not frustrated in that. But the idea is, hey, look, Charlotte, we had $300,000. Now we only have $100,000. Let's keep spending like we were. I mean, it's just stupid. No one's going to do that. No one's going to sit there and say, okay, I'm down to my last penny, I'm going to spend it. Everyone's going to, I mean, no one does that. I mean, common sense has to dictate here. If you're down your last $55,000 and you're used to spending $60,000 a year, at some point, you're going to say, we need to tighten our belts. And maybe take a reverse mortgage, maybe downsize, maybe just I don't know what it'd be. But, the idea that you're going to keep spending each and every year with inflation, come hell or high water, there's just no evidence of this, man. None. And so the reason I use the 5% rule, and maybe one of these days I'll even say 6. I don't have enough guts to do that yet. But simply because we actually have evidence in the other direction. People's spending goes down, significantly down as they age. This really, at this stage, there's no debate on this. Now, the debate is, why does that happen? But not does it happen. The answer is it happens. Why does it happen? Are they running out of money? I don't think so. In fact, I think there's the preponderance, is that right? Well, the evidence is pretty overwhelming. It's not that people run out of money. It's just that people have a different mentality when it comes to taking principal versus taking income. So when you're working, you got a salary coming in, you're spending like a drunken sailor, part of my Navy buddies out there, because you're like, man, I got money, I got replacement income coming in 2 weeks of my next paycheck. When it's coming out of principal, though, it's a whole different story. You had $100,000, now it's $80,000. That changes your mindset. It's psychological on do you really need that new pair of shoes if it's coming from principal as opposed to if it's coming from income. And one of these days, I've read this article on it, and I always meant to read it to you. And one of these days I will. It's fascinating. It's fascinating, the psychological dynamics of principal versus income. And so anyway, that's one of the reasons, in my opinion, why the spending drops, because people no longer have a salary coming in. All they got is Social Security and or pension, which usually would be enough, but not all the time. And so now they're being very diligent on how much of this principal they spend. And so what happens here on top of that is another guy did a study, I forgot who it was, but a Journal for Financial Planning. He did a study, said if the market's down 10%, I think he had 5%. Maybe it was even more than 5%, but we'll just say 5%. He had a 5% rule. And his idea was, if the market is down 10%, do not give yourself a pay raise for inflation. So December 31st to December 31st. On December 31st, you have $100,000. You fast forward to next December 31st, it's down to $90,000 or $89,000. Just take out the 5%, the $5,000, but do not give you a pay raise for inflation. And he said, if you did that, you're fine. 5%, you'd never run out of money. And that's so anyway, long-winded answer to your question. I just frankly find the 4% rule, the premise of it flawed, is that you're going to be spending more and more and more and more and more each and every year inflation. There's just no evidence of that whatsoever. But healthcare cost, for the love of the good Lord, I hear that all the time. And it's just not that debilitating like people think. It's just not in there. And when we look at the BLS, with the Consumer Expenditure Survey, the HRS from the Health and Retirement Survey over at University of Michigan, healthcare is in the top 5 of your expenditures. We know that. Transportation, healthcare, housing, food, and I think entertainment is number 5. Maybe something like that, but taxes, something like that, I can't remember. But anyway, transportation, healthcare, housing, food, and there's another thing I'm missing there. And basically, housing is way up here. Everything else is jockeying for number 2 position. And basically, when he hit about, I think it's 75 or 80, healthcare finally solidifies its place as number 2 expenditure, but it's not anywhere near housing. It's just not. And so this is when you're like 85 or 80 years old. I can't remember. But at some point in the future, when you're older, healthcare does become a bigger and bigger expense, but not to the extent that it's not going to bankrupt you. Yeah, so it does. Some people, I don't get that. I mean, literally, some people do get bankrupt from healthcare, but not where you say, I can't spend more than 3.2% a year, because there's no evidence of that. Let's see here. Corey says, moving out of personal capital. Ooh, all right. And then Lisa, it's like a Rumba, but for the lawn. Oh, very pricey. That's why my man Jeff can afford it, because he got all that money sitting in cash. Why? Look, man, what is it with people hating on Jews? I just don't get that. I literally don't get it. It's the weirdest thing to me. I've never understood this antipathy towards Jewish people, especially if you're Christian. You have no. The funny, the Jews represent such a small minority of the world that the idea that they're going to be dominating the world, and it's just nuts. So some guy, you probably didn't see that in the comments, but some guy had some anti-Jew stuff to say. You got to feel sorry for these people that they literally feel this tiny minority of people is going to have world domination. And if you're a Christian, what the hell was Jesus? No. Oh, by the way, he wasn't an Arab. Who was some lady saying, some congresswoman say Jesus was an Arab? Oh my gosh. For the love of God. All right. So what else we got here? Heard Motley Fools cleared their calendar for May 3rd. Motley Fool has cleared their calendar to watch me and Dustin live and in person in Seminole, Florida, wherever that is. Bernie, Josh says video is 5%. Yeah, there you go. 5% right on. Hey, my man, Rob. Now, Rob is I think Rob's an IP, intellectual property lawyer. So if you all know anything about IP, address it to Rob. It's actually interesting because I do think that has a significant issue with our Trump's trade war with China. They're stealing our stuff, man. They're stealing it, and we're not getting anything back. We got to police that crap up. Corey's moving out of personal capital. Why, man? That's nuts. Because you were the person who recommended it to me. Josh and Tom Major, thank you. Debt free. We'll have 2 government good-sized tip. Yeah, man. Yeah, I haven't mowed the lawn in 3 years. 90-degree days like today here in North, maybe love it even more. Man, that's it was tough. Look, I'm from Maine, my friends. I'm Maine. The humidity eats me alive, and it was bad today. It was bad. I don't know if you saw my videos I did on my take on debt. Whew, sweating like a pig. Woo, and we just begun. In fact, let me show you something. You guys will like this. All right, so here it comes. All right, so there's where I used to live in Bernie, Texas. All right, so you can see that's South Texas, 87, 84, 83. All right, what's going to happen in good old Alpharetta, Georgia? Look at that, 90s. There you go, 90s. And it's going to be humid as crazy. And where am I from? Peaks Island, Maine. That's 50s. 40 degrees different. 40 degrees different from Peaks Island, Maine and Georgia. Look at Rapid City, 36. They're expecting, holy crap, snow. Snow in Rapid City. Yeah, maybe that's a little bit too cold for your old buddy Josh. That's cold, man. That's freaking snow. That's nuts. So anyone out there from South Dakota, Rapid City, is that that scares me. Think about that. As Chris, hey Josh, I suggested my daughter today go with a 70-30 split C fund, S fund. She's only been in 10 months, Army, and just getting started. I also sent her Roth videos to help me out. Yeah, right on. Good. For fear of running out of money, not by choice. I run out of money. But that is right. They spend less than out of money, but that is a choice. That is a choice. I mean, they have the ability to spend more. They're thinking that they're going to run out of money, so they don't want to spend more. Doesn't change their capacity and would do so. That is a choice they're making because they're concerned, and I find that to be too bad because the retirement crisis. Snow in California later this week. Yeah, man, I heard that, Rodney. That's nuts. Do I get more on here? I guess that's it, huh? All right. I guess. Oh. Yep. I guess that's the last one we got. It looks like it's logged me out anyway. So, all right, my friends. Corey, if you're still here, are you still? Climate changes. So apathy. Climate. I don't look, man. I'm not one of these guys of weather, and this is what the climatistas always say. There's all. You can't use the weather to dispute climate change. Then when it gets hot, they use the weather to dispute climate change or to argue in favor of climate change. You can't, man. I mean, it gets hot, it gets cold. I mean, climates change. That's the whole reason why it bothers me to be called a denier. No one denies that climate changes. Hell, we know we had a little ice age and we know we had the medieval warm period. We know these things happen. This isn't rocket science. The question is, why do they happen? And if CO2 is the culprit, how do we attribute the Little Ice Age in the medieval war period if there was no CO2 from industrialization? Anyway, personal capital investment stocks only based on everything I'm. So Corey, as I was asking, are you now just using the? You're just using the right capital solely, Corey? Okay, I guess I did ask. And he said, "Yep." Yeah, okay, cool. Personal capital is costing $2,000 a year. Yeah, and then Daryl says personal capital investment stocks only based on evening out market sectors. That's what they pitched me. I said, no way they take. Yeah, I see. That's the thing, man. I heard that too, Daryl. Is that you give up your your personal capital to give access to the software, and they'll be calling you like crazy people. And I just don't like that stuff. It's not a bait and switch. You know what you're getting, that you're going to get a sales call. But yeah, $2,000 a year. Damn. All right, my friends, I appreciate it. So I guess the last thing, don't forget. Oh, that's what I was going to say. Yeah. So don't forget, I'll be with Dustin May 30th. So be live. We're going to figure out a way to do it live on both channels. If not, we'll be on his channel, which is Jazz Wealth. All right. JazzWealth.com. Oh, not Jazz Wealth. Maybe it is JazzWealth.com, but it's Jazz Wealth on YouTube. So that'll be May 30th. We'll be there at 1 and 5. I'm going to do a couple videos tomorrow more on the Social Security 62 to 70. And there I'm going to do with expenditures. Actually, going back to Corey, he talked about it'd be a lot more realistic if you had expenditures on there. And I 100% agree with that. The issue I was doing is when I was doing my Social Security video using my horse's mouth calculator, it's in a vacuum. I mean, saying 62 versus 70, and but your financial planning is not in a vacuum, and so I want to do it with the taxes included, and then on top of that, and your expenditures too. What if we need money to come from? And it'll be interesting to see. I just don't know. And remember, the basis is if I take Social Security at 70. All right, I missed those 8 years of X amount return. In this case, I'm using a aggressive portfolio, getting 7.1% a year. So if I have 7.1% a year on $18,000, or I don't have anything for those 8 years, and instead I wait until I'm at 70, and I have $31,000, what will be better from an overall cash flow, net worth, tax scenario? And that's the premise. And so the horse's mouth thing, just on 62 versus 70, and this, I've done this in my own spreadsheets. If you can get more than 4% a year and you're in this vacuum of just Social Security now or Social Security later, you should take it now without question. But you don't live in a vacuum. That's the issue. All right. So I'll put that out there mañana. That means tomorrow for you guys in Spanish. And I'll be back on Monday night. I'm going to do this every Monday. So have questions, and we'll see you guys next time. Thanks now.